Hello and welcome to this special broadcast where Nigeria's Central Bank Governor Godwin Emefiele will outline the position of Nigeria's Monetary Policy Committee in its fifth meeting of the year. Now, looking at global development, central banks around the world are in a battle to tame inflation. From the US to Asia and Europe, policymakers have their work cut out, but it's not just inflation. Currencies are also taking a hit. In England, the pound hit a record low against the dollar, while the euro slumped to fresh lows as recession fears continue to persist. Here in Africa, South Africa raised their repo rate by 75 basis points. In Egypt, the Central Bank of Egypt took analysts by surprise by keeping its rate unchanged, but raised the reserve ratio to 18%. Meanwhile, in West Africa, the Central Bank of West African states raised its key rates to 2.5% last week, while monetary policy decision in Ghana is on hold until the authorities conclude their two-week-long meeting with the IMF. Earlier in an emergency meeting in August, the Bank of Ghana raised its policy rate by 300 basis points to 22%, while inflation hit a record 33.9% in August. Coming back home here in Nigeria, Nigeria's Monetary Policy Committee unanimously voted to raise the monetary policy rate by 150 basis points and followed through with another 100 basis point rate hike in July. Despite these interventions, Nigeria's inflation in August crossed the 20% mark, and the local currency is still hitting new lows at the parallel market. Quite a lot for the MPC to consider today. And to discuss the options before the committee today, we have Bismarck Rewane, the CEO of Financial Derivatives and a member of the Presidential Economic Advisory Council, and Lawrence Harms, the head of Africa Trading at Rand Merchant Bank. At some point later in the show, we'll be joined by Tilewa Adebajo, the CEO of CFG Advisory. Thank you so much for your time today, gentlemen. And let's start with what we're seeing play out on the global front, and more or less how we're seeing global central banks respond to the shocks that we're seeing play out globally. Bismarck?
Yes, quite frankly, we had it coming, and ordinarily we would have actually had to wait for policies of the last two meetings to feed through to the system. But what has happened now is that we are so interconnected with global events that we cannot ignore it. The strengthening of the dollar, the 75 basis points further increase by the Federal Open Markets Committee, and another one expected at the next meeting, makes it very clear that our options are limited and our choices are hard. Therefore, we think, and based on what we've seen in the power market, which has dropped this afternoon to 7.25 naira to a dollar, which is unprecedented, we think that the MPC will have no choice but to lift the interest rate by at least 50 basis points minimum or 100 basis points, and that's a 60% probability. I'm convinced that that is the step that they will take, failing which the consequences is that the naira will sink further and the interest rate inflation differential will widen and the pressure will continue on the domestic markets.
All right, Lawrence, Bismarck says we might see a 50 to 100 basis points increase today. Do you share the same opinion, or what do you make of how the global central banks are responding to these shocks that we're seeing play out?
Yeah, as Bismarck mentioned, I think there's quite a bit of front loading happening in the developed markets at the moment. They're raising rates quite aggressively and quicker than markets that are originally priced in. And I think we've seen a lot of African central banks having to respond in kind. As you mentioned in your introduction, South Africa has also raised, and we expect more increases at subsequent meetings, which puts a lot of pressure on the Central Bank of Nigeria today, I think, to raise. As you said, they've raised 150 and 100. I think 100 would probably be what the market would be looking for. I know the consensus is for 50, but I think there's a higher probability of 100. It's a fine balancing act because I think there's a lot of other metrics that are in play. If you look at cash reserving ratios, also naira stability is quite a big focus of the CBN, and with this gap between the official rate and the parallel market, it's not sustainable. Something's got to give, and I think we're looking just for the message from the central bank to be that they are on a continuous trend of tightening. There are other concerns to address in terms of liquidity. Local currency liquidity still makes it seem like the monetary conditions are quite easy onshore, but they've actually started tightening. So difficult balancing act, but I think 100, and we've penciled in another 100 before the end of the year.
All right, Lawrence says it's a difficult balancing act, and we might see there's a high probability of a 100 basis point rate hike. Bismarck says we could see maybe 50 to 100 basis hike. And if you're just joining us, Tilawa Debajo, the CEO of CFG Advisory, has just joined us for this conversation. And I'd like to get your take on what we can expect today.
Well, we have to take a look at the situation we're in. We have inflation at a 17-year high. Inflation is now at a runaway point. Unemployment is at a 25-year high. Growth is stagnant. And there's now a 65% differential between the official and the parallel market rate. Combined with that, you have a fiscal regime that is now unmanageable, or untenable, as we see. And it seems that the physical issues have overwhelmed the whole economy. Right now, the economy is in stagflation. So that is what we're facing. So what are the policies, or what, if you're taking a look at interest rates or basis points increase, is that going to have an impact? Real rates are already negative as we speak. So inflation has eroded value in the system. So yes, the last speaker talked about a fine balancing act, but I think it goes beyond that, because it's now a situation whereby with stagflation and the situation of growth in the economy, will an increase in the rates, will it make an impact? Are you going to increase interest rates above the rate of inflation to be able to make that manageable? So the question now is the fact that we're now in a situation whereby the best thing the central bank can do now is to begin to address the issue of the differential between the parallel market exchange rate and the market exchange rate. That is the only monetary tool it has at its disposal to make an impact on the economy. A basis rate hike in interest rates will not make any impact on the economy with the way we are. That is my opinion.
All right, Atilewa says a rate hike may not make any increase here, but it's good you brought the issue of currency, and Bismarck, you also mentioned that as well. And looking at the wider implications that we're looking at here, we're trying to achieve exchange rate stability. Many other issues are playing out with FX. We're not seeing as much inflows as we would usually get. And I'd like you to speak to these two fronts more or less, and the challenges that we're facing in those areas. Bismarck?
Yes. I listened to what Tilewa said just now. The reality is that we are looking at the nominal rate, which anchors inflation expectations. But the nominal rate, which is the MPR, seems to be disconnected from the rest of the other rates. Well, what we have seen in the last 2 months is a shift in the interest rate structure at the bottom. I.e., the treasury bill rates have moved significantly from 5% all the way to 9.5% for the one-year notes, and from 2.5% to 5.5% for the 90-day rates. So what that has done is to actually, one, reduce the marginal propensity to consume, and has also increased the cost of debt service for the government, right? All of this has meant nominally a shift in spending patterns, but that's not enough. You have supply shocks, you have fiscal dominance, and you also have a growth situation, which is Tilewa described as stagflation. It is real. Now, how do you deal with this in the midst of a political campaign, which is opening up tomorrow? So no matter, central banks everywhere in the world they obey the 60 to 3-month rule. You do not make any move 3 to 4 months into the election or before the election. If not, it will be misinterpreted that you are either regime friendly or anti-regime, even though central banks are supposed to be independent. So the policymakers are going to be considering all of this. One, how do we steer and maintain our independence? How do we deal with the economic issues, which cannot wait, because doing nothing is no longer an option? So you will have 2 major options: move the treasury bill rates higher, move the MPR by what we say, but at the same time adjust the exchange rate in the I&E window, so that you can mop up as much liquidity and put in foreign exchange to that market. The problem is the central bank has been rationing foreign exchange, and that has led to this current speculation or a speculative attack against the naira. 725 naira is quite a very, very frightening number. However, please know that it's not just the naira. The rand has fallen to its lowest level. The British pound has been crushed. The Ghanaian city is limping for breath. So I don't want to just, policymakers are not going to be looking at the Naira in isolation. They're going to be looking at the context. Is it the dollar strengthening or Naira weakening? And the domestic rate of inflation now being measured may not be the reflective symptom of what it is. It doesn't really portend or portray the true cost of living index that we see today. So all of these things are going to be put together in the considerations that will inform a decision. But I can tell you one, the options are limited and the choices are hard.
Bismarck says the options are limited, and he also talked about challenges we're seeing play out with FX there. And I'd like to bring in Lawrence here, more or less looking at the markets that you track across Africa, more or less how currencies we're seeing play out have been affected by previous rate hikes, and more or less on how you see some things panning out today for the Naira.
Yeah, so I think some of the key themes that are playing out across the rest of the region is a question of debt sustainability. I mean, we've Bismarck and has touched on the fiscal issues. I think the debt burden is starting to become a bit of a problem. You've also got obviously the issue of subsidies and heading into election that's already been moved out a year, which it was expected to be unwound this year. So I think that one of the key themes that's playing out across the region is debt sustainability. We're seeing a lot of IMF engagement from other central banks and ministries to try and look at their debt burdens. So it is a time of quite a lot of pressure on Africa in general. I think it's been coming for some time, and obviously the effects of COVID and the Ukraine-Russia conflict just came it was just a perfect storm for Africa, with already struggling macros and a strengthening dollar and a policy cycle that has changed. So almost all the external factors are putting pressure on the currencies. So as Bismarck mentioned, it's not necessarily a weakening Naira. It's a strengthening dollar. We've seen currencies weaken across the board. So they have to address the FX issue. I think the investability of the market is becoming weaker as global rates move up. If you've got the long end of the bond curve still trading around 14% with inflation at 20, I mean, you've got negative real rates across most of the rates, nominal rates across the spectrum, OMO rates, T-bill rates, the MPR rate, they're all in negative real rate territory. So if you look at an investment case, it's very difficult to commit capital when FX is seemingly still at overvalued levels. We understand the sensitivity around the movement of that rate into an election cycle, but I think they definitely have to address some of the concerns, even though they're in an election cycle. It's globally, everything's moving on, so it's quite a critical inflection point.
Definitely quite a lot to address there. Both Bismarck and Lawrence agree that we're not seeing a weaker Naira, but more or less a stronger dollar, and now that is playing out. But then when you look at Nigeria and the challenges we're having with FX inflows, especially this year, you're looking at the magnitude of oil theft that we're seeing playing out. Tilewa, what other options do we have here as a country?
Well, we have the options are as a question of what exactly is the focus of the country? Are we going to pursue a growth strategy, or do we want to hold things down? Now, the FX regime in Nigeria is as a result of the problems of the multiple rates that causes a distortion on the real market rates. So that problem has not been resolved. When that problem is resolved, then we can now begin to look at more of how the external factors of a stronger dollar is impacting the Naira. Secondly, the fiscal challenges are distorting everything. The government revenues cannot even service the debt. So in order for us to go forward, we need to admit that level of government debt and also the 25 trillion in ways and means that is driving this runaway inflation. So the first thing we need to do is we need to take a break and say, okay, this is the level of this problem. $100 billion debt stock and 25 trillion in ways and means. We need to reset that, and we need to restructure our debts for us to get a clearer picture. Because if you do not resolve the fiscal issues, monetary policy is going to remain completely ineffective.